Imagine a world without connectors. Not smartphones, not data centers, not fighter jets. Literally none of it works without the tiny pins, sockets, and cables that link every electronic component to every other. That unglamorous, invisible layer of technology is worth hundreds of billions of dollars, and one company has quietly dominated it for nearly a century.
Amphenol Corporation. Founded in 1932, headquartered in Wallingford, Connecticut, market cap today around $170 billion. They make the connectors that make everything else possible.
And in January 2026, they just made the biggest move in their history, spending $10.5 billion to acquire CommScope's connectivity and cable solutions business. Welcome to Charged Alpha, episode 122. I'm Hudson Thomas.
And I'm Lana Chen. Today we're going deep on APH.
Let's start with the basics. Amphenol operates through three segments. Harsh Environment Solutions makes connectors that survive military aircraft, oil rigs, and deep-sea equipment. Communications Solutions handles the high-speed interconnects for data centers, telecom, and smartphones. And Interconnect and Sensor Systems covers automotive, industrial, and medical applications.
What's remarkable about Amphenol's business model is the customer stickiness. When an OEM designs your connector into their product, you're in for the life of that product platform. Those design win cycles can last 5 to 10 years. That's recurring revenue with real moat characteristics.
And then there's the acquisition machine. Norwitt and his team have done over 70 deals since he took the helm in 2009. Not flashy mega deals, historically disciplined bolt-ons that build capabilities and geographies, until the CommScope CCS deal changed all of that.
The CCS acquisition is a different scale entirely. $10.5 billion in cash for a business generating about $3.6 billion in annual revenue at roughly 26% EBIT margins. It closed January 12, 2026. For context, Amphenol's own market cap was around $130 billion when they announced it.
The play is clever, though. CommScope CCS unit sells fiber optic cables, data center structured cabling, and broadband infrastructure products, all markets where AI-driven build-out is accelerating. They're plugging right into the hyperscaler spending wave.
And there's a cross-sell opportunity. Amphenol walks into the same data centers where they already sell high-speed connectors and can now offer the cables too. One account, bigger wallet share.
Richard Adam Norwitt joined Amphenol in 1994 through an acquisition of a European connector company. He rose through international operations and M&A roles before becoming CEO in 2009. He has a law degree from the University of Chicago, which gives him a very analytical, contractual view of how deals should be structured.
The results speak for themselves. Under Norwitt, Amphenol's revenue has grown from about $1.5 billion to over $23 billion. That's compound growth through both organic expansion and over 70 acquisitions. What's notable is the discipline. He's historically avoided overpaying, buying niche businesses at reasonable multiples, and then growing them inside the Amphenol ecosystem.
The CommScope CCS deal tests that reputation. $10.5 billion is a big number, and analysts are watching closely to see if the integration playbook that worked for smaller deals can scale to this size.
The early read is positive. Management guided for CCS to add 15 cents to 2026 adjusted EPS, and they didn't revise that down after closing. That's a good early signal. Let me walk through the financials. Starting with valuation. Amphenol trades at roughly $138 per share as of our data date. At $169 billion in market cap, you're paying about 39.5 times trailing earnings and 7.3 times trailing sales. Those are premium multiples for a hardware company.
Is that premium justified?
The growth suggests maybe. Q4 2025 revenue came in at $6.4 billion. That's a 49% increase over Q4 2024. For the full year 2025, Amphenol generated about $23 billion in trailing 12-month revenue. The pace of growth has been extraordinary.
And that's before CCS is fully baked in for a full year.
Exactly. Analyst Consensus for full year 2026 revenue is around $31 billion. That would represent roughly 35% top-line growth from 2025. A lot of that is CCS. On margins, gross margin runs about 37%, operating margin is around 26%, and net margin is 18.5%. These are strong numbers for a hardware company.
How's the cash machine running?
Very well. Trailing free cash flow was $4.4 billion for 2025. That's a free cash flow yield of about 2.6% at current prices. Operating cash flow was $5.4 billion. The balance sheet got more complex post-CCS. Cash of $11 billion, but total debt of $15.5 billion, giving you net debt of about $4.5 billion. Management guided pro forma net leverage at about 1.8 times, which is manageable but worth watching.
What's the forward picture?
The forward PE sits around 32 times based on 2026 consensus estimates. Not cheap, but Amphenol has historically commanded a premium multiple and delivered on it. Overall, Amphenol's financial health is strong. The core business generates exceptional cash flow, margins are expanding, and the CCS acquisition adds strategic scale even as it temporarily increases leverage.
So what are the analysts saying about all of this?
The consensus is firmly bullish. Out of 23 analysts covering APH, 18 have buy ratings, 4 have holds, and just 1 has a sell. Average 12-month price target is around $169. That implies about 23% upside from where it's trading now.
That's a meaningful gap. Who's making the biggest calls?
Jefferies upgraded to buy in March 2026, specifically calling out AI-driven connector demand and upside from CCS integration. JP Morgan calls APH a core holding for AI infrastructure exposure and maintains overweight. Barclays upgraded to overweight in January after the Q4 beat. Citi is sticking with buy, modeling the 15-cent EPS accretion from CCS.
What about the recent earnings print?
Q4 2025 reported January 28th was a beat on both lines. Revenue came in at $6.4 billion versus $6.2 billion estimated. EPS was 97 cents versus 93 cents estimated. Full year 2025 was a record on both top and bottom line, above the high end of management guidance. Next earnings are April 29th. Consensus expects around 94 cents EPS and $7 billion in revenue. That'll be the first quarter with CCS fully consolidated.
All right, let me make the bull case. The simple version is, every hyperscaler on the planet is spending billions on AI infrastructure, and Amphenol makes the connectors that tie all of it together. Jensen Huang can unveil as many GPUs as he wants. They're useless without Amphenol's high-speed interconnects linking them inside the rack and between the racks.
That's the core of it.
Layer on the CCS acquisition. Now you're not just selling the connectors inside the data center, you're selling the fiber cables running between the buildings. Total addressable market just doubled. And with AI inference moving to the edge, you're going to need that same fiber infrastructure running to every enterprise campus and cell tower. Amphenol is positioned at every layer.
Add to that the defense boom. NATO spending commitments are driving record demand for harsh environment connectors in military aircraft, missiles, and surveillance systems. And the EV transition means dramatically more electronic content per vehicle, which means more connectors per car. 3 secular growth vectors at once.
That's the bull case. What worries you?
The CCS integration is the number one risk. Amphenol has done over 70 acquisitions, but nothing at this scale. $10.5 billion is a step change. If the integration takes longer than expected, or if cost synergies disappoint, the market will punish this premium valuation quickly.
The leverage angle, too.
Yes. Net debt around $4 to $5 billion post-CCS, leverage at 1.8 times EBITDA. That's not crisis territory, but it does constrain the M&A machine while they pay it down. If a compelling deal comes along in 2026 and APH can't act because of the balance sheet, that's an opportunity cost.
And the valuation itself is a risk.
39 times trailing earnings is pricing in a lot of execution. One guidance miss, one quarter where data center spending slows or CCS integration runs hot on costs, and there's real multiple compression risk. The stock doesn't have a cushion.
How does APH stack up against its closest peers?
The most direct public comparable is TE Connectivity, ticker TEL. TE is the largest connector company globally by revenue and competes with Amphenol across automotive, industrial, and communications. TE trades at about 22 times earnings and 3 times sales, meaningfully cheaper than APH on every metric.
Why the gap?
Growth. Amphenol is growing revenue at 49% year over year in Q4. TE connectivity is growing in the mid-single digits. When you're compounding at that rate, markets will pay up. Sensata Technologies is another connector adjacent player. Trades at about 15 times earnings, 1.8 times sales, reflecting its slower growth profile and more cyclical end markets. Then there's Belden, focused on cables and connectivity infrastructure, trading around 18 times earnings. None of them are growing like APH right now.
So the premium is essentially a growth premium.
Correct. And if APH delivers on the $31 billion revenue consensus for 2026, that PS multiple compresses meaningfully even without the stock moving. The question is whether they can sustain the growth trajectory.
What's the options market telling us?
The put-call ratio on APH sits around 0.72. That's a call-biased setup, meaning options traders are more interested in upside exposure than downside protection. Implied volatility is at roughly the 34th percentile, not elevated, which suggests the market isn't pricing in outsized post-acquisition uncertainty. The biggest open interest cluster on the call side is in the 145 to 160 range, with puts concentrated around 125 to 130.
So the options market is saying the base case is a grind higher, but not a rocket ship.
That's a fair read. The low IV environment actually makes it relatively inexpensive to own upside calls into the April 29th earnings. That might be the most interesting trade setup heading into the first CCS consolidated quarter.
What are the insiders doing?
Modest selling, 6 transactions, mostly option-related exercises by executives, 2 small open market purchases, no large insider buys, but that's fairly typical for a company at this valuation level. Norwitt has maintained his stake, which I read as quiet confidence rather than urgency to exit.
Let's crystallize the key things to watch.
3 things. First, the April 29th earnings report, specifically CCS revenue contribution, integration costs, and whether 2026 full-year guidance holds. Second, data center CapEx signals from the hyperscalers in their own earnings. If Microsoft, Amazon, or Google start trimming infrastructure budgets, APH moves quickly. Third, leverage trajectory. Watch net debt and EBITDA quarterly. If they're paying down debt on schedule, that removes a key bear thesis.
Time to bring it home.
Amphenol is the picks and shovels play for the AI infrastructure build-out, the defense boom, and the EV transition, all happening simultaneously. The CCS acquisition is transformative and introduces execution risk, but Norwitt has earned the benefit of the doubt. The financials are exceptional. The valuation is premium but defensible given the growth rate.
The one metric I'd watch most closely?
CCS revenue in the Q1 2026 print. If CommScope's business is tracking toward the full-year $4.1 billion target management guided, the integration thesis is on track. If it misses, you'll want to reassess the whole setup.
I want to leave you with something Norwitt said that I think captures what Amphenol really is. He said, "The secret of my success is that we have gone to exceptional lengths to hire the best people in the world."
For a company that's done over 70 acquisitions, that's not a platitude. It's the actual operating system. Integration works when the people you're bringing in want to be there and the culture absorbs them. 70 deals, same playbook.
That's going to do it for episode 122 of Charged Alpha, our deep dive into Amphenol Corporation, ticker APH. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
Until then, I'm Lana Chen.
And I'm Hudson Thomas. Until next time.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street